Before the new year, Congress shelved the vote on reauthorization of the federal backstop for terror insurance, prompting a loud outcry from insurance industry leaders and trade groups. While passage of TRIPA was not guaranteed after the new year, the new Congress made it a priority, and last week TRIA was reauthorized through 2020. So just what was passed in the new bill? Here with a follow-up is Tracy Dolin. She is a credit analyst at Standard & Poor's and joins us from S&P's studio in Manhattan. Tracy, welcome to the program.
Thank you.
So Tracy, it seems like Congress just wanted to put us through our paces. What happened in D.C.?
To recap, last month the House passed the TRIA bill, and it didn't even make it to the Senate floor. So as a result, TRIA reached its year-end expiration without a reauthorization. S&P already anticipated in our ratings that the reauthorization wouldn't take place until earlier this year. So the good news is that the lapse of government backstop program for terrorism is short, reducing uncertainty in the market.
In summary, what was passed?
Well, basically, TRIA extends for another 6 years, and the private market is going to bear a somewhat higher proportion of the terrorism risk. The major phased-in changes include raising the coinsurance to 20% from 15%, doubling the industry event trigger to $200 million from $100 million, and a higher recruitment of $37.5 billion from $27.5 billion. And now the Secretary of Treasury needs to consult with the Secretary of Homeland Security before certifying a terrorism act. These changes should not lead to market disruption nor reduce insurers' willingness to offer affected coverages. Therefore, as is the case with the short-term lapse of TRIA coverage, this should not affect our ratings on insurers.
So who gets hurt most by the changes?
Well, generally we believe that smaller carriers' capital and earnings are more at risk. And when I say smaller, I mean those with capital levels below $250 million or so, given a potentially detrimental impact on capital from a large single event. And that's where the doubling of industry event trigger plays in, as this group may not even see any TRIA reimbursements. Not to mention, they're likely to have greater geographic concentrations, more reliant on reinsurance, and generally less sophisticated terrorism exposure management. Most of these insurers of this size are not rated by S&P. However, given earlier talk of even higher industry event triggers and even higher deductibles, which were not even amended here, this new program is not scaled back as some market constituents had originally expected. Therefore, we do not foresee smaller insurers pulling back from the market or any other systemic changes.
Now, a lot of work was done at 1/1 to carve out terror cover. Reinsurers were busy backing up terror exposures. Was that all for nothing?
Let me start off with the primary market. Remember, there was not actually a lot of time leading up to the 1/1 renewals for insurers to make last-minute changes in the policies to carve out terrorism, given it caught the industry by surprise that this bill did not pass in December. And all the talk about sunset clauses and other contingency plans, for the most part, were put into place earlier this year, when TRIA passage was less certain. Through the passage of time, it seemed that TRIA would get reauthorized, so many of those clauses dropped. As far as reinsurers, remember too that most U.S. cedents' property catastrophe treaties begin on 6/1 or 7/1. So 1/1 was inconsequential, though it wouldn't preclude a small number of treaties were successful in getting terrorism coverage slipped in. The good news is that reinsurers have shown increased appetite for terrorism risk, more so on conventional losses, though in our view, it's not enough to cover $100 billion of industry protection afforded by TRIA. But most importantly, the passage of this bill by Congress should promote greater underwriting stability.
What happens next? Do you think Congress might change the law again in the future?
From our reading of it, the TRIA reauthorization contains some indications as to the potential direction of future or additional legislation. Among the key points was Congress requesting studies for the certification process, which is important considering terrorism acts are evolving. For instance, TRIA does not clearly define cyber attack as a terrorism event, but many interpret it to be included. Congress also requested a GAO study looking up terrorism upfront premiums for the purpose of creating a reserve fund. And why that's important is because if you think about it, the number of years that passed since 9/11, there hasn't been a certified event. So in theory, insurers, for the most part, have pre-funded their deductibles through TRIA premiums. However, they did not reserve these funds. The Congress has also requested an annual study of small insurer marketplace competition, which could allude to differentiated terms for smaller insurers. But I think the more important question is, will there ever be a point in time that this program will be permanent? If the outcome of these studies translates to a longer-term or permanent program, the industry might embrace changes to come.
Well, at least Congress made a decision. Thanks for those insights, Tracy.
Thank you.
For more on TRIA and the impact of Congress on the insurance industry, visit the S&P website or the RIN TV On Demand Library.